We've just come off the back of a very strong month in May where many stocks are up, and in fact significantly, and that is also the summary for the S&P itself, where it's up more than 6%, something that's very rare, and the majority of this growth has been attributed to the large drive we've seen in information technology as well as consumer discretionary, which have really pulled the markets higher. And one thing that's very interesting to point out, that typically sell in May and go away is the worst performing month and duration in the markets on a 6-month basis going from May to October. So actually last month has gone against the norms, and looking forwards to this month in June, it isn't typically a very strong month, but also neither is it one of the worst performing, where over the last 100 years the markets have been up this month at 0.76%. Now speaking as of today, we do see the overall markets looking fairly red, unless you're holding many companies in the energy sector where they are up, but again it is fairly marginal. And we have the ongoing trade war to thank for that. Just a few days ago we had Donald Trump accusing China of violating the preliminary trade deal that they had agreed, where they were putting a pause on some of the ridiculous tariffs that each country had imposed on other. We're talking in the 100-200%. In fact, Donald Trump did go as far to say, so much for being Mr. Nice Guy, and that typically adds to uncertainty and volatility in the market, which is completely understandable. And now today we have China accusing the US of seriously violating their trade truce, and this isn't helping the market settle down. As we showed you, the beginning of the week, many companies are down, and this could end up being a very turbulent week, because it doesn't stop there, because we even have the EU who strongly regret the increases that Donald Trump has imposed in terms of steel, and they've said they're prepared to counter any of these new additional tariffs, which again, as we say, volatility comes from a lot of uncertainty, one thing the markets don't like, but unfortunately something we're seeing at the beginning of this month, and therefore there should be no surprises to see that the uncertainty has been going higher in just the last few days. Whilst we're not at the peak that we saw during Liberation Day, we can in fact see we are on a very large upward trend, and whilst perhaps we don't like to see this, it does give good opportunities to consider adding high quality undervalued companies, something many investors got to do during Liberation Day, where many tariffs were put across many different countries at some very high rates, which did send the market crashing down. In fact, we note here the 10 trading days that shocked the financial markets. This is because we saw trillions and trillions of dollars being wiped out on the market, and whilst this felt like a very bad period, some investors did capitalize, buying some very attractive companies, as we said, at undervalued levels. We even have it in the history books, April the 4th, as one of the worst sell-offs in history, at least in the last 20-30 years, where the markets just on one day were down more than 10%. Yet at the beginning of the week, investor sentiment is still sitting high, sitting at 62 greed. As we've discussed on earlier episodes, it does feel like retailers in particular are continuing to buy the dip, and as we spoke about on the weekend's episode, analysts believe that many investors are now becoming desensitized to any of these ongoing tariff issues. But we have to make it abundantly clear that no matter what valuation metric you look at for companies, overall the markets look to be overvalued. If you want to see it on a forward P basis, overvalued. If you want to look at it at a price to sales, again, many companies overvalued. We can keep going all day, but this again showing price to earnings growth, again, many companies deep into the red, trading at some severely high levels. And one additional layer here, price to book, again showing that same exact conclusion. Now we are starting to head out of earnings season as well. We have one or two perhaps notable companies that are yet to report. We, for example, are waiting to see Broadcom after market close on Thursday, and for those that do like high growth companies, we have CrowdStrike after the market close tomorrow. But as we are moving away from earnings season, it does look like a lot of the volatility that now will be created in the market will come down to where we go towards where these Trump tariffs are going to take us. And a final reminder here that not only are the markets looking overvalued, at least in comparison to history, but when you start to think about the sectors where there are opportunities, something we have covered many times, healthcare sector as well as energy are looking like one of the most undervalued industries, and definitely something to consider if perhaps you are someone that does want to look at sector by sector basis. Those are looking fairly promising. Now today we're going to uncover 8 stocks that we believe are at great opportunities, but before we do, we just want to highlight we have released our latest free weekly article we draw on every single Monday morning to your inbox completely for free, so we have just released one minutes ago where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a recently released copy of severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab another recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can read straight away. Now jumping into the first company, we have Novo Nordisk, the Danish pharma company that has been absolutely battered, down 46% over the last year. Year to date down 17%, but over the last 10 years it's still, after the battering is taken, outperformed the S&P up 150%, trading right there near its 52-week low, but now sitting quite some large way away from its all-time highs at $149. And we get a notice here that both Seeking Alpha and Wall Street consider Novo Nordisk to be a buy right now. We can also point out that based on a forward P of 17.3, it is significantly below the 5-year average of 30.4. That is one severe undervaluation signal, and in fact near one of the lowest it has been valued for over the last 5 years. The same to be said on dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year average, 2.26, well above 1.41, near the highest it has offered. Again, double severe undervaluation signal for the company. But not only that, it's also reconfirmed when we take a look at this model. We have the blue tunnel signaling the expected intrinsic price. Not only is it increasing over time, which is something we always want from companies we're considering to invest in, but the stock price itself is going the opposite way. That is great, a company that's being worth more and more over time, but the stock price doesn't follow that and goes the other way. And since the beginning of the year, disparity has only got larger and larger from even the bottom line, so all signals to Novo Nordisk are telling us severe undervaluation. Now we're also going to run through our own valuation process shortly too, and in terms of the growth, well, they get a C+, yet revenue year on year up 24%, forward looking up 20, well above the sector comparative around the mid-single digit, and even growing at a faster rate than what they have done over the last 5 years at 18 and 15% respectively, whilst also anticipating earnings per share growth at 14.5% over the next 5 years, well above the sector at 10 and pretty much in line with their own historicals. Also worth highlighting that over the last 10 years, their sales growth, whilst has been a little bit inconsistent, has been very strong, at least from 2019. The last 3 years, double digit, and even on a trailing 12 month, 24%, looking very impressive. And just in their most recent quarter, top line was up 19% from the same quarter last year, and we can see their fastest growing revenue segment, the obesity care with Wegovy, up 67%. We also like to see that over the next 3 quarters, they anticipate each one of them to be growth to the EPS, whilst they do have a 75% track record. 3 out of 4 beats against analyst targets. Nice to see the most recent 3 have in fact been outperformances. And if we look towards December 2026, their next full accounting period, their forward P based on that is sitting at 15.4. Now finally, before we get to the valuation, institutional ownership sitting at around 12%. They've been selling 5.6 billion over the last year, but they've been buying a little bit more at 6.6. However, whilst we see this trend over the last year, important to highlight here that in the most recent quarter, we see the opposite. They actually sold more than they bought, 2 billion sales versus 1.5 billion worth of buying, a trend that we haven't seen actually go that way in quite some time, perhaps around 2022, where we do see a lot more selling than buying, something worth flagging. Now, our intrinsic value for the company gets to $82 today, derived from the DCF model. Now we have the free cash flow year on year average at 10%. Moving forwards, we've gone around analyst expectations at 14, but you can see low, medium and high, 12, 14, 16 respectively. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Novo Nordisk or any others. With 14% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $82, as we can see, implying 15% upside. Now, you may be a lot more conservative and believe that we should use 12%. Well, that pretty much tells us, given it is near the current market value, that if you are buying the company today, already baked into the numbers is future growth to the free cash flow at 12%. Definitely something worth highlighting. And for those that believe we should be a lot more bullish at 16%, $93, 31% upside. As typical on the channel, we will take through the median rate of 14%, where we're not done because we like to apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy at $74, then we keep going till it's near the current trading price. And in essence, in today's episode for NVO, we see 15% MOS around the $70 mark, with Wall Street themselves seeing this at $94 over the next year, translating to 34% upside. Now we can show you, for those that want 20%, a buy at 66, at 25, $62, and at 30% around 57, which is where we did in fact see it around the Liberation Day period. But as of now, 15% MOS, 34% upside. Also give us your thoughts, Novo Nordisk, buy, hold or sell. We then move into the semiconductor space with Advanced Micro Devices, but also known within the community as Advanced Money Destroyer, is down 32% over the last year, year to date down 6%, but over the last 10, if you've been a longer term shareholder, you would still likely love the company, as a massive outperformance here of 4,800%. Trading near their 52-week low, although we do see Liberation Day dropping this to around the $76 mark. Double buy from both Seeking Alpha as well as Wall Street, and it wasn't that long ago, in fact towards the middle of April, where we did see it trading at an forward valuation of 18.4, making it the lowest in a decade for the company. Although now, as it has started to rebound, it is starting to climb higher, but as we can see, this company historically has traded for some very, very high multiples. In terms of growth though, looking very strong, similar to Novo Nordisk, around the 20% year on year and forward looking, when the sector in comparison does sit in the mid-single digit rate. But worth highlighting, whilst this company did trade at a higher valuation, historically it's also grown its revenue at a faster rate. EPS projected 26%, well above the sector at 14%, but we can see not only revenue historically grown quicker, but so did the earnings per share at 33%. In terms of their growth though, bearing in mind this is a cyclical industry, not too bad. We do get 2 years negative growth, including the most recent 2023, but in 2024 and a trailing 12 month, we do in fact notice double digit, and their most recent quarter showed 36% in terms of growth to their top line year on year. Data center, which was the most looked at, up 57%, now making around 50% of their top line, with efficiencies noted to their margins. Very impressive, 3 percentage points to their gross margin, 10 on the operating and 7 on their bottom line. They do, however, anticipate 3 of the next 4 quarters to be growth, with a 100% track record, trading on 2026 numbers at a forward P of 19.4, and institutions hold 71% ownership, pretty much the same in terms of selling and buying, not that far off. However, we do notice in Q1 a little bit more buying than selling. Previous quarter though, we did get that opposite trend, so no real clear indication, at least for the time being, whether institutions are bullish or bearish. Now intrinsic value gets to $137 today, where we have gone for a growth rate of 25%. If you're someone that believes that is in fact too high and would prefer 20%, then you can see intrinsic price sits around $98, $99, and there's downside of 11%. For those that are a lot more bullish, given the fact that we've heard from both the CEO of AMD and Nvidia that data center will be climbing at a very drastic rate over the next few years, 30% would show upside of 73. As we said, taking through the medium rate here at 25%, you are getting a margin of safety, and as we keep on going in the episode today, pretty much bang on 20%. Wall Street themselves, $130 price target, 18% over the next year. Give us your thoughts. Buy, hold or sell, 20% MOS, 18% upside. If you wanted 25%, $103. If you wanted 30, $96. As we said though, 20% margin of safety, 18% upside. Digging with these semiconductors, we move on to ASML, which are down 24% over the last year. Year to date, up marginally 6.5%, but over the last 10 years, whilst like AMD outperforming, not to the same extent, up 584%, trading near their 52-week low, with a double buy from both Seeking Alpha as well as Wall Street, and we do get the undervaluation signal, trading at a forward P of 26.6, when the 5-year sits above at 33.8. However, the yield currently isn't dissimilar from their 5-year average. We also get that confirmation here that this company is trading below the bottom end, which does signal undervaluation, something we have seen pretty often, at least over the last 12 months, although we can see Liberation Day was where we saw the most largest gap, and as of now it is starting to get smaller and smaller. Their growth does come in at a B-, year on year 18%, forward looking 10, still above the sector in the mid-single digit, but we can see over the last 5 years they have been growing their revenue at a slightly faster rate, whilst anticipating 19% growth to the EPS above the sector, but marginally below their own historical. Now, growth does look very strong. Again, this company, like AMD, is in a cyclical industry. 3% though in 2024, pretty much just about keeping up in line with inflation, trading to a month looking strong at 18%. And their most recent quarter, we saw a very large increase, 46 to their top line year on year, with nice efficiencies noted, 3 to the gross margin, 9 to the operating, and 7 to their bottom line. And they do anticipate 3 of the next 4 quarters to be growth, 100% historical track record, trading on December 2026, forward P of 24. Now, institutions hold 26% ownership, very similar to some other companies today. Very minimal differences between buys and sells. However, in the most recent quarter, we can see nearly 3 times as much buying than selling, so at least confident here to say they're more bullish in the most recent period. Now, intrinsic value gets to just over $1,000, where we have used a growth rate of 14%. That indicates 44% upside. Now, we'll show margin of safety based on different growth levels, but at the medium one at 10%, a buy at 950, at 20 still a buy, and we can in fact see you are getting 30% MOS for ASML if you do agree with the growth rate. Wall Street themselves, $943 price target, 29% over the next year. They're also fairly bullish. Now, for those that believe we should use the 12% rate, again, just showing here that you are still getting a fairly attractive margin of safety. As we keep on going, instead of the 30%, you're still getting 20, which does look respectable for a company with a very wide moat. Give us your thoughts though, 20% MOS, 29% upside, is this still one that does excite you? And we can go one step further for those that believe 10% is the most appropriate rate. You are still at a 10% free cash flow growth rate, getting near 10% margin of safety. Again, let us know your thoughts below. We then move on to SoFi, which is up around 91% over the last year. Year to date, however, still down -13, and we can see it trading around the midpoint of the 52-week range with just one buy rating as of now from Seeking Alpha. And one thing that this company does very, very well is their growth in their members, which at the end of last year, we did see it above that 10 million mark, and this continues to grow as noted in Q1 of FY25. Now, in terms of evaluation, they do get a C-, as we can see. If you're looking at a forward P, they do trade at a premium to the overall sector, around 350%, but this is pretty much the same no matter what valuation metric you look at. SoFi does trade at a premium. You have to ask yourself, is it worth the premium and how much? Because on the growth, they do get an A. As we can see, year-on-year revenue and forward-looking, well above the sector in the mid-single digit. However, they're not growing as fast as they have done historically. EBITDA growth also looking promising, 43% expected, well above the sector at 11, but as we note here, well below the 5-year at 109. We can also see this is a growth company, but is starting to slow down, currently at 28% over the last full year, 24 on a trailing 12 month, and in their most recent quarter, they did see the top line growth of 20%, which was very impressive, where we note the largest driver was from the financial services, up 101%, but also that is driving significantly in terms of the margin, up 24 percentage points, as well as growth noted to both members and their products. They do also anticipate 3 of the next 4 quarters to be growth. Great to see, 100% track record, and given the earnings per share estimate for 2026, the forward P is expected to come all the way down to 25.9. Institutions holding 38% ownership, they sold around 1.1 billion, bought a little bit more at 1.5. However, we should point out in Q1 they did sell more than they did in fact buy. Now, intrinsic price gets to just under $16. Now, you can see we've used a growth rate of 10% moving forwards, but if you believe it should be lower at 8%, you are still seeing upside, and at 12 around 41. So using that middle rate there in terms of a margin of safety today, you're getting 10% around $14, 20% around the $13 mark. Not far off there, and we can see Wall Street anticipate $14.50 into 2026, upside of 12%. And we've done an exercise here just for entertainment. If this company does end up with the same market cap as PayPal, then the price will be sitting around the $73 mark. That is upside of 458%. Again, this isn't something we are anticipating over the next few months, but for those that do want to have a medium-term goal. We then move on to a company that has also been battered heavily, that is PepsiCo, down 23% over the last year. Year to date, down 15%. Over the last 10 years, up only 39%. Bear in mind two things. One, this doesn't incorporate dividends reinvested, and secondly, this is if you'd bought 10 years ago today. In terms of where it sits, well, trading right there near the 52-week low, and interestingly, we get a triple hold from every single analyst. Yet when we take a look at the forward PE, 16.4, this is now the lowest it has offered to shareholders in the last 5 years, well below their 5-year average at 23.8, and we can see the yield highest on offer 4.33 with the rolling average at 2.9. We also get that confirmation of undervaluation, but this is one that has been significantly overvalued over the last year. Disparity right now is at its peak, so another severe undervaluation. Its growth, however, does make you understand why the company has been battered and may not be for everyone. It does get a D year on year, pretty much flat, the same to be said moving forwards, which when you incorporate inflation does mean in real terms it is decreasing. Sector not that much better, although it is positive, and over the last 5 years they have historically grown their top line in the mid-single digit rate. They're also let down here by the EPS expectations of under 4% when the sector sits at 6 and their own 5-year at 7.1. You can also see their growth isn't that promising, at least in the most recent period. 2024, 0%, yet historically they have for the most part been increasing in line with inflation. Definitely something to bear in mind and incorporate into the margin of safety. And in terms of earnings, they do anticipate 3 of the next 4 to be growth, 75% track record, with the most recent earnings being a marginal 1 cent miss, trading on 2026 numbers at a forward P of 15.6. Now, institutional ownership does sit at 73%, 10 billion worth of selling, double the amount of buying, so at least over the last year they've been very bullish. The same to be seen here in quarter one. Institutions have been buying a lot of shares of PepsiCo in comparison to the selling, and our intrinsic value here 161, the average of these 3 models. Remember, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own company, whether it's for PepsiCo or any others. But at 10%, a buy up to 145, at 20%, pretty much where we see this company now, a yield of over 4%, MOS of 20, Wall Street forecasting 162, upside of 26. Give us your thoughts. Maybe this is one you do like, or maybe this is one you don't want anywhere near your portfolio. We should also point out with this company that in their most recent earnings, their top line was down 2% year on year, and we do see only very marginal improvements to their efficiencies. So all of these things to take into consideration, at least when looking at a margin of safety. But moving on to the next company, we have American Express, up 24% over the last year. Year to date, down around 2%, but over the last 10, outperforming the S&P, up 267, trading in the upper end of the 52-week range, double buy from both seeking alpha as well as Wall Street, and we do notice both forward PE as well as the yield not too dissimilar from the 5-year average. This in itself would be a reasonable signal, and that's also confirmed when we take a look. Again, very nice to see the blue tunnel is increasing, but as of now it is trading in the upper end. Growth is at a B+, 9 to 8% forward looking year on year. It is slightly above the sector in the mid-single digit and pretty much in line with their own historicals around the 9 to 10%. Earnings per share looking promising though, with 14% expected moving forwards, given the sector sits at 10, but they actually grew it much faster historically at 21%. Now their sales growth, at least for the more recent period, it does look very promising. We're talking nearly double digit in the last 4 years and on a trailing 12 month. And over the next 4 quarters, they anticipate every single one of them not only to be growth, but double digit, with a 75% historical track record, trading on 26 numbers at a forward valuation of 16.9. And we see here institutional ownership 84%, 10 billion worth of selling, around 50% more in terms of buying at 14.6 billion. And we also notice in Q1 more buying than selling, institutions definitely more bullish, and our intrinsic value gets to $325. As we do take a look at a margin of safety today, you're getting over 10%, not quite 15% just yet. That is perhaps where we would consider a position, but as of now, sitting somewhere between 10 to 15%. Wall Street themselves, limited upside at $320, as we can see 10% into 2026. Give us your thoughts though. Some people may really like this company. It is one of Warren Buffett's longest holdings, and maybe you could consider this as a dollar cost average position. We then move into one of the most unloved companies, at least in the Mag 7, that is Alphabet, pretty much flat over the last year. Year to date, down 11%. Over the last 10 years, outperforming the S&P, 516%, trading near the 52-week low, double buy from Seeking Alpha and Wall Street. Wall Street, in fact, 4.41, not far off the 4.5 for a strong buy rating. And we can see the undervaluation signal, 18.6 with the 5-year at 22.1, one of the lowest over the last 5 years. And that's also confirmed when we take a look here, but understand that this is getting nearer and nearer to a reasonable valuation. And their growth also looks strong at a B-, year on year 13%, forward looking around 12, given the sector does sit in the low single digit, but historically they've grown their top line at a faster rate, around the 15 to 17% region. EPS projected 15% growth, well above the sector at 11, but we can see historicals higher at 18. Now their growth has been very strong, 9 of the last 10 years double digit, notably the most recent period sitting at 14%, and just in their most recent quarter we see revenue up 12%, also their search advertising up 10%, one that in fact many analysts do believe is dying, and we can see their fastest growing revenue stream, Google Cloud, up 28%, and efficiencies noted to every single margin. They anticipate 3 of the next 4 quarters to be growth, 100% track record, trading forward PE 16.9 on 2026 numbers, and this is one that institutions clearly like. 40% ownership, 50 billion selling, nearly 100 billion in terms of the buying, and we can see the same to be said in Q1, more buying than selling. Now our intrinsic value gets to $226, and as you can see here, you are getting upside of 35%, in fact upside even if you use the lower rate, but sticking to the middle of 10%, as we keep on going, you can in fact notice you are getting a very healthy MOS, not at 30%, that would be buy at 158, at 25, pretty much near the 170 mark. That is a very nice margin of safety if you believe in the long-term longevity of the business and that they will be able to ride out any waves that they do stumble across. Wall Street themselves, $200 price target, 20% upside. They definitely see this as a buy in the portfolio, as we highlighted, near a strong buy rating. And for those that do want to see it at the 10% level in terms of a margin of safety, you are getting at least 10%, buy at 177, at 15 is pretty much bang on, so even at the more conservative rate, 15% MOS. And just for those that do want to see it at the 8% level, we are noticing the intrinsic price 171, not that far off, so already baked into the numbers around a price of 170, 171, there is 8% growth to the future free cash flow. Again, let us know your thoughts. We then move on to LVMH, down 32% over the last year, year to date down 17%. Over the last 10 years, even after the drop, still outperforming the S&P, up 204%, trading near their 52-week low with a buy rating from Seeking Alpha, and they trade on a forward P around the 20 to 21 mark. And if we look on an EV to EBIT basis, they are actually trading at a historical low around the 13.8. Definitely one to consider if you do believe the company will come out of these issues a lot stronger. And in their most recent full year accounts, their top line was down 2% year on year. We can pretty much see nearly every single income stream has taken some kind of a hit, but not only that, also margins lowering 2 percentage points on the gross, 4 on the operating and 4 on the bottom line. And we can see only marginal growth anticipated forward looking at 2.21, when the sector itself pretty much sitting around the same. So it isn't just an issue isolated to LVMH, but historically they've been growing 10% year on year. One thing, however, we will point out is that the CEO has been constantly buying shares. Their most recent, in fact, the 23rd of May, we can see they just continue to buy every few days, and we're not talking about a little amount, many shares, 10,270 at the beginning of the May, and we can just see the continuation. We're talking millions and millions of euros. Now intrinsic price gets to $641, and if we were to use an MOS, you can see it is very significant, not at 20% just yet, but you are getting around 15 to 20. This is one that has been battered very significantly. Wall Street themselves do see this as a buy, $680. They anticipate upside of 26%. As always though, give us your thoughts. LVMH, is this one for you? If not, perhaps let us know why. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover up buyers and sells, and as always, have a great day. We'll see you all on the next one.